Welcome to Investors Insights. Our topic today is panic not required. In case you haven't been listening to the news or reading headlines, a lot of things have taken place over the past week, and a lot of concerns have been voiced by a lot of media and economists out there. Market Insight. We're here today as Five Plan Partners and our portfolio strategies team to bring you data that will give you excellent insight as to what's actually going on, and that it's not an emotional knee-jerk reaction. We hope you find these blogs very valuable, and we also, on these type of blogs, hope you forward them to friends, family, and colleagues who are concerned about things that took place last week. Again, our topic is panic not required. Bobby, I'm going to go to you first. Distinguished guest here and colleagues of mine, Bobby Norman, Trey Booth, Ty Miller. We've had an intense meeting this morning. And Bobby, you gave a great perspective on the bank issues that took place last week. So talk about that.
Yeah, Greg, we want to address what happened last week in the banking industry and explain why the market had such a tough week. So last week, the S&P 500 was down 4.5%, mid caps down 7.4%, and then small cap stocks down 8.1%. And the sharp pullback in the market was due earlier in the week when the Federal Reserve said that they were going to still have work to do and expected further rate hikes. Later in the week, it was the failure of Silicon Valley Bank. But we want to focus on Silicon Valley Bank and explain why the market reacted so negatively. So, and the best explanation of what happened is that Silicon Valley Bank was uniquely at risk because of its unusually low percent of individual depositors and its unusually high portfolio of loans and securities backing up their deposits. Another problem is that the bank's clientele was mostly startup companies in the technology and the healthcare sectors. And so on Thursday, the bank had $42 billion in withdrawals leaving the bank. And that left the bank with a negative cash balance, which was immediately followed by regulators stepping in to take over the bank. So I want to share three charts that show why the market reacted so negatively to the news, and one chart that shows why the bank was uniquely at risk. First chart shows that Silicon Valley Bank was the 16th largest bank in the nation by total assets. So it wasn't surprising that the market is concerned by its failure. Its larger size isn't something that can be ignored. This next chart here, it was the second largest bank failure in U.S. history. So the fears of a 2008 run on the bank scenario obviously was running through investors' minds. I'll talk in a second about why we feel that's not the case. This third chart explains why Silicon Valley Bank situation is so unique and why the news of its failure was initially a worry, and that because 97% of deposits at the bank exceeded the $250,000 FDIC insurance cap. And lastly, the last chart I want to share shows why Silicon Valley Bank was indeed a class of its own, a really bad combination of the lowest percent of retail depositors and the highest percent of loans and securities backing up their deposits among all similarly sized banks in the country. The second worst bank by these measurements, Signature Bank, was also suddenly forced into receivership by regulators yesterday on Sunday. So the two banks that were taken over by regulators are the two banks that had the highest risk. The important point I want to make, and this is important here, is that a large majority of U.S. banks are in much better financial shape than the two that you see circled in this chart. It's something we'll continue to watch here regarding the banking industry.
Yeah, and Bobby, that was a great summation and a great way to present it. And I want to say to our viewers as well that, I got into this industry in the early 80s when Chrysler was going under, other banks were closing. We had double-digit interest rates. Inflation was still alive and well. And the point I want to make is that through that evolution and through that journey of my career, this is nothing new. We have banks that go under and the Fed steps in. And so the reason we chose the topic, panic not required, is please know on the portfolio strategies team here at Five Plan Partners, we're watching these situations very closely and navigating through them in relation to your financial blueprint and also in relation to your portfolios. I also just from the standpoint want to say that on social media, as well as a continuation of one-on-one conversations, we're going to continue keeping you updated on this. But the biggest thing is our concern for people who read the headlines, buy into the emotional media that's taking place, to understand these are facts that Bobby presented. This is data, and data is very important. The facts tell us where things are going and how we can keep you informed. And then Trey, you did a great job in regards to still talking about the Fed, about inflation. Will rates go up? What's the battle that's going on right now? So talk about that because it's important.
Yeah, absolutely. We've been saying, and we've got this quote from our partners at Strategas that traditionally the Fed raises rates until something breaks and then they stop. It can be something small, like in 1998, it was long-term capital management, the largest hedge fund in the world. The Fed came in and had to save that hedge fund. It could be something large, like in 2008, the entire housing market. And so we've already seen parts of the economy break. We saw crypto nearly collapse. We saw the collapse in the tech industry. IPO market has dried up to near zero. So and now we've had a failure of a bank. What'll be interesting to see is this failure of Silicon Valley Bank, is it an extension of what we already knew was a broken tech market, or is it a new breaking in the economy where it may be a weakening of the banking system? Time will tell, but we do have a short-term indicator of that, and that is market expectations for Fed rate hikes. What does the market think the Fed's going to do? So Jerome Powell spoke last week to Congress for 2 days, and over those 2 days, as Bobby mentioned, interest rates spiked as Jerome Powell made it clear that the Fed's number one goal is to fight inflation, and the way they're fighting inflation is raising interest rates. On Friday, the news about the banking concerns pulled rates back down, and so on Tuesday, tomorrow, we're going to get a new report on inflation. And so what'll be huge to see is how do market expectations react to that inflation report. We expect a 6% CPI. Where that CPI comes in above or below that 6% number will be telling on a year-over-year basis. But more telling will also be, how does the market react? Does the market say, okay, the Fed is back focused on inflation, so expectations for interest rates are high? Or does the market say the Fed is focused on the banking sector, at which point interest rate expectations come down? And so very important data points this week, because there's a lot of conflicting data and some tug of war between who's going to win. Has the Fed done enough to break what they feel like is reasonable to bring down inflation, or is there more to go? And I think this is a very important week for that data point. And inflation coming out tomorrow is good because we don't have to wait. We've been waiting for this inflation print since the last Fed meeting, all the way back on February 1st. And then the next Fed meeting will be on March 22nd.
Let me say this, Trey. I really appreciate the way you explained all that, because it also shows there's more pieces to the puzzle. There's a lot more you need to look at besides focusing on the headline that just took place with Silicon Valley Bank and some of the other banks that just happened. Again, why we're saying panic not required is that let's stick with the facts, let's stick with the data, and that makes a huge difference on how people can navigate through this, how we make decisions for that. And if clients need to discuss with us about their portfolio strategy and their financial blueprint, we're available. But at this point in time, we're looking not only as to what's taken place, but for things to come. Mm-hmm. How does all that pan out? And then Ty, really appreciate what you did this morning, Ty. On Friday, we were all looking for a certain news, which you're getting ready to talk about. And that headline was ripped away because of Silicon Valley Bank and all that was taking place there. Talk about unemployment, jobs. Talk about that in relation to the Fed as well and why that's important.
Yeah, so Friday's focus was supposed to be jobs report. We still got it. I know nobody saw it, but we still got the jobs
right.
report.
No, yeah. It's like, hello.
Added 311,000 jobs. That's a strong number right there. Unemployment rose from 3.4 to 3.6. So a little bit of mixed data there, but the unemployment rate rose because there are more people in the workforce. Labor force participation rose by the same amount. That's very important. There's more people looking for jobs. That's something that we've been wanting to see, and I believe the Fed's been wanting to see. We still lack a little bit in the leisure hospitality sector. We would like to see that. We'd like to see average hourly earnings probably increase a little bit, but overall a fairly mixed report, which in times like this can be good news. So how does that impact the Fed? Well, if you looked at just a week ago, there was a 31% chance that there was going to be a 50 basis point hike by the Fed. And now we're saying that there's no chance of a 50 basis point hike. Of course, that'll be, confirmed with inflation data. Things change every day. But now we're saying there's an 86% chance of just a 25 basis point hike. And even for the first time, a 14% chance roughly of no hike at all, a pause. So things change a lot in a week. We have, a month, a day, a week here. Things changed a lot in the past week due to this news. And it'll be interesting to see if they're going to change. We still got another 9 days or so until they meet. So it's going to be another, eventful week for the Fed to see what's going to happen here.
That's what people need to keep in perspective, is that the news will constantly come out. We will tie that to what's happened in the past, see where this could take us. We're very focused on our clients' financial blueprints. Just to remind everybody, we do worst case planning here at File Plan Partners, looking at scenarios on an ongoing basis in relation to portfolios. And so this news that you're talking about that came out on Friday is, again, pieces to the puzzle, and it makes a big difference. So, folks, at the end of this week is St. Patrick's Day. We are not operating here at File Plan Partners on the luck of the Irish, although we support that wholeheartedly for each and every one of you to have a good time later this week. What we will say to you, though, is that the facts and the data speak for themselves, and what we see here, panic not required. So with that note, we want you to have a great week. Know that we're available, and know that these vlogs, social media, one-on-ones, as well as the speaking events that we're hosting, we will continue having all those to keep you updated as we see the headlines come out, to make sure that our clients don't have to resort to emotional reactions. Go have a great week. We thank you for believing in us, and know that every day here at File Plan Partners, we walk through our doors to make our clients' lives better, richer, fuller. Thanks.